everyone. Good morning, good afternoon, good evening, those of you joining us today. We have set up a very interesting panel today to talk about the use of alternative data. We've got representations from the buy side, sell side, and vendor space. I will let my panelists introduce themselves in a minute. My name is Michael Steliaros. I run the Quantitative Execution Services Group at Goldman Sachs. This is a bunch of quants dealing with the algorithmic implementation and the execution services of the firm, dealing with a lot of big data, machine learning techniques around the execution space. And I will be moderating this panel today. Let's start with our panelists. I'll let you guys spend a minute or two, discuss your sort of area of expertise and what your firms deal with in the context of our talk today. We'll start with Lorn.
Good morning, good afternoon, everyone. My name is Lorn Davis. I'm the VP of Product and Corporate Strategy at Facteus. And at Facteus, we're focused on partnering with banks and financial institutions to safely and securely bring their valuable transaction data to market. And so we do this for a large number of banks, and we've put together a large consumer payments panel that's focused on the United States and covers a number of different consumer sector tickers and companies. So our interest is really focused on supporting buy-side clients as well as a number of other verticals better understand business drivers using consumer data.
Thank you. Cetin?
Hello, everyone. My name is Cetin Karakus. I run the Quantitative Analytics Solutions at BP. BP is one of the biggest players in the energy markets. We operate both in financial and physical markets where logistics, planning, and delivery operations play the key role. And I've been heavily involved in the quantamental analytics over the last 5 years and hope to bring some commodities market perspective to the discussions.
Thank you, Cetin. Sam?
Good morning, good afternoon. Sam Livingstone. I'm the head of data science at Jupiter Asset Management. We are a predominant long-only UK-based asset manager running about 58 billion sterling. I joined in December 2018 to set up the team. We were one, me, and we're now 7 in the process of becoming 9. So the team's building out pretty quickly. Prior to this, I worked at Citadel, and before that, I was at Schroders.
Great. And Suraj?
Hi, everyone. My name is Suraj Gohil. I'm the Chief Strategy Officer and co-founder at Fable Data. Fable Data is a European transaction data company. We partner directly with financial institutions in a similar way to Facteus, unlocking consumer transaction data, which then structure and then sell to predominantly to the buy side as well as corporates and other investor verticals such as private equity and venture capital.
Thank you. As you've all seen on the invite, there are 3 broad themes that we will touch upon in today's talk. One is the impact of COVID-19 on the utility and consumption of alternative data. The other is the data sourcing and evaluation of new data sets. And finally, the fundamental versus quant and systematic method approaches to alternative data. I think we'll start with the most topical of all, which is the impact of COVID-19. Right? So we've seen a lot of changes in our industry over the past year. What have you observed in terms of the use of alternative data? Has this been spurred on or actually put in the back foot with the advent of COVID, brave new world? Do alternative data sets help, or were they more of a nuance during this period? Let's start with maybe the buy side this time. So maybe Cetin?
Yeah, one of the things I think what we observed during the COVID is the inadequacy of some of the traditional data sets. For example, for basic things about, we used to look at the factory activity, etc. So obviously during the lockdown and shutdowns, those data weren't available. So people start looking at the more a direct source of activity. So for example, two examples to come to my mind. One is like looking at the, the power consumption, electricity consumption profile to gauge kind of the real activity. And also a second example is looking at the, traffic and road analysis and seeing how, whether actually people are kind of moving around. But in commodity space, I mean, use of alternative data sets are not a new thing. I mean, we've been doing this for a long time, because if you're dealing with the physical operations, you have to deal with the alternative, what's now called alternative data sets. So I will give you three areas where it's heavily being used. Like first is the supply demand economics, right? You have to look at the supply side, demand side factors, macroeconomics, international flows. So all of these require using alternative data sets. Second is like physical operation, like logistic operations, looking at the, like, for example, production. A great example is the shale production or well activity, right? Transportation activity like pipelines, strike, shipping, storage. That's become a major thing in the March 2020, when the oil price has gone negative because of the the storage constraints in the Cushing, Oklahoma. Similarly, in the midstream, like when we in the refining, processing, and packaging and distribution, when we look at the retail, commercial and industrial distribution of the products. So third area is like we also use in the financial markets as well. I mean, everyone probably familiar with the commitments of traders reports in the futures market. In recent times, people kind of augmented their data set with some alternative data sets to kind of enrich it and, to use kind of innovative visualizations. Increasingly looking more at the kind of the news data coming from, Bloomberg, Twitter, and other social media sites. And last but not least, in applications analytics, like the data coming, I'll call it like attention monitoring, like seeing how the market participants are reacting to the some of the events and news in the major trading platform like Bloomberg, Refinitiv, and others. So in summary, I mean, alternative data sets are kind of has been part of the commodities markets for a long time, and continue to be so.
Sam, you've been dealing with a lot of data all your life. What have you observed over the course of last year?
Yeah, I'd echo that. I think it's really three things. The first thing is very similar. Traditional metrics that discretionary managers look at become uninteresting. The sell side sort of hum monotonically because they don't really know what's going on. So traditional metrics don't become particularly useful. So people come to you and say, what else can we be thinking about? And it could be things like geolocation data. It could be sentiment. It could just be a better grasp on instantaneous news flow. So people come to you and say, what I traditionally look at is no longer useful. I'm looking, I'm driving, looking through the rearview mirror, and the mirrors are foggy. So how can you help? So people who traditionally weren't, say, keen to engage suddenly become keen to engage. And lastly, actually quite a few different places, because of it being COVID related, start providing things for free. So you don't actually necessarily have to spend money to get people on board. You can say, look, I think your problem can be solved with datasets 1, 2, and 3. Incidentally, they're providing free feeds to help with COVID-19 at the moment. Why don't I show you what you've got? And so you don't have to go to the sophisticated end. You don't have to start talking about AI and machine learning. It's just beautiful basics, just basic data analytics, and saying, here is movement data from Apple. Here is movement data from Google. Let's just see how people are moving in and around cities. And people slowly start getting on board with using alternative data. And the benefit to my team is kind of the frog in pan method, really. You start really basic and you slowly heat them up to alternative data. But now they have a reason to engage with you first. You're not pushing things. People are coming to you saying, where do I go? What do I do? And the benefit, repeating myself, but the fact that a lot of vendors are saying, we appreciate this is uncertain time. Our 30-day trial is now a 90-day trial, has been incredibly helpful for onboarding and testing a number of different data sets.
Okay. So that sounds like a positive kind of development, in the sense that maybe all processes, all data didn't work that much, and using the COVID-19 excuse, we are delving deeper into other use cases. And Suraj, have you seen that?
You've always got your quantitative folk who are interested. You've always got the certain fund managers who've been engaged with this topic from the start. It's more the sort of the slight skeptics, or the people who are, let's talk next week. The next talk next week people are suddenly wanting to talk today.
Great. Suraj, what have you seen from your side? Is there more demand for your data? Like, how are people using, or have they changed the use cases?
Absolutely, the demand has certainly picked up. But it's worth pointing out that COVID broke many things, and it actually broke some alternative data sets at the start of the period, where you had traditional panelization methodologies, which just didn't stand up to scrutiny anymore, and they needed to be adapted. But I guess where I'd like to take this is to show that this kind of echoed through an entire ecosystem. So, very simply, if you're looking at reported revenues from, say, an individual company, it's very hard to dispute what those numbers are. So if your data set proxies well to them, it's good data. The line, however, does start to blur when you start looking at macro numbers. Macro numbers, as we're all aware, are typically survey-based. They use stale weightings, and they're very, very small samples. And, to give you an example of this, if you look at some of the macro numbers produced regarding grocery spend during the COVID period, they were clearly wrong. And the reason they were wrong was because the weightings that were being used for grocery was kept constant from a pre-COVID environment to a COVID environment. I know for sure when I used to eat out a lot at restaurants. We've come into a COVID environment. Most of my spend has been diverted into grocery. As we start to exit, it will start to move again. This, however, has led to something good coming out of this. You now have the Bank of England who are using CHAPS data, which is basically real-time aggregated consumer spend data at a very high level. However, the Bundesbank are publishing a weekly activity index using alternative data. And I guess what I'm saying is the adoption of alternative data sets is starting to become a lot more mainstream. So you are starting to see governments engage. At Fable, we're quite keen on working with government bodies. We work directly with the Treasury and the IMF, and we are helping them out, trying to get a real grasp of what's going on in real time. The other thing that we've done is we made our data freely available to the highest levels of academia, who start to look at data through a slightly different lens. And actually, one of the academic reports that was produced using our data ended up on the desk of the UK Chancellor, who immediately set out a task force to say, hey, we should be looking at this data so we can start to measure the socio-economic impact of any of the stimulus that we're putting through the economy. So I guess what I'm saying is COVID has certainly accelerated the use of alternative data, and it's becoming increasingly more mainstream. Ideally, we're going to get to a point where you'll end up with macro numbers being based on some combination of traditional data as well as alternative data. However, the difference being the alternative data should be freely available to all, and that should start smoothing some of the market volatility and ultimately lead to slightly more efficient markets.
And on the other sort of side of the fence in the US, Lorn, what have you seen there?
Very similar to what's been mentioned. I think, kind of picking up where Suraj was taking us, we saw similar interest from, government in using alternative data to better forecast, retail spending, especially, I think, as Suraj mentioned, doing it more quickly, right? So there's a number of Federal Reserve banks that we work with that are doing nowcasting using our data, plus a number of other sources, including traditional, to better understand retail spending. You can aggregate it up. Ultimately, we've worked with academics who aggregate it up to GDP kind of level forecasting. So you see that interest. On the buy side, what we've seen is a lot more interest from both the quantitative side, but also the fundamental side. I think a lot of players started to understand that traditional data sets were a bit slower. It wasn't as granular. For example, when I was talking to a lot of fundamental analysts last year, they were really interested in understanding particular regions where there is maybe lockdowns occurring or there's different policies in effect that could be affecting the particular business that they're trying to analyze. So I think across the board, we saw an increase in interest. But I think we also saw, many people intimated to challenges last year, models breaking, panelization breaking, the ability to merge different data sets together to get a better view started to become more and more important. So I think across the board, you have interest, but also some interesting challenges that we had to address.
Thank you. Maybe let's go into a little bit more detail about what we do with this data and how we sort of bring them through the door and how we evaluate them. And one of the main questions for everyone is the build versus buy sort of question. And I won't ask Lorn or Suraj about that because obviously the answer is buy. But maybe starting with Sam this time. In your career, you've worked both for fundamental and quantitative shops, and I know from my perspective as well, from a bank's perspective, always the kind of inclination is to build everything ourselves. And I think most quants, most sort of systematic processes would tend to veer towards that. Now, that comes with costs, explicit or implicit ones. How do you see that evolving recently, Sam?
Yeah, I think it's horses for courses. It depends what you're trying to achieve. So if you're looking at web scraping, for example, it typically is best, depending on what you're doing, to do it yourself, because you can monitor the process. So if things fall over, you know how the data was imputed during the gaps. You can sort of silo what you want to be specific, but then you lose the fact that some vendors might have history. So actually, there's kind of three. There's buy, there's build, and there's combine. Sometimes combine is the right answer. What I think people do incorrectly is they go for the most granular, most complex, fastest data first, become overwhelmed, and then they lose their buyers. So the principal thing you want to concentrate on in my role is time to delivery. So you want to get stuff in front of fund managers quickly so they start making use of the data, and then you can increase the level of complexity. Gartner talk about it through their waves of innovation. So you start basic and beautiful basics, and you move up to the more complex. So it's about having an efficient pipeline. It's about standardizing where you can standardize. It's about using the right tools. So, we use things like Snowflake. But it's really about getting a clear hypothesis from the start and making sure you design what you're building or buying to match what the outcome should be. I think in many cases, the right answer is combination rather than one or the other. But typically we will usually start at a buy. So we'll go and engage with the gents here, for example, explain our use case, and usually take a 30 to 90 day trial to answer a very specific question. Once we've demonstrated a vendor aptitude and that it does help solve what we're looking for, we then start to pervade the data more widely, at which point you can go more granular, or you can increase the cadence or whatever it is you might need to sort of spin up. But I think it's, KISS, I think it's the old definition, keep it simple, stupid. So it's about doing the basics first.
And Cetin, I guess you have a wealth of data that are in-house. VP obviously has a huge amount of data around its own, operations and your own data sets. How do you see this playing out? What's your use of external versus internal data?
Yeah, I think the most important thing, internal or external, doesn't matter. Data costs money. So you have to have a way to ultimately have a metric to show the cost of profit, right? If the data is being used to generate some P&L, you have to be able to assess the cost of profit, and that will basically settle the score about whether one data set is useful or not. But getting there is a bit tricky. So I have developed a kind of a more kind of a methodological framework, quite involved. I try to explain in the limited data time. So the first step is obviously data identification and classification. So what kind of data you're dealing with? Is it price data? Is it logistical data, economical or news? Whether there are substitutes or complements? What's the arrival or change frequency of the data? What's the granularity? Like, is it daily or is it more kind of a higher frequency? Is it the realized data? Is it forecast? What's for example, the reliability of the vendor? So is it the high cost data or low cost? What is the licensing implications of users? Is it being used per user or across the enterprise? How stable is the structure of the data, right? So basically you kind of assign some score to this and classify your data. That's the first step. Then you go through to the second step of looking at the metadata. What kind of metadata is provided by the data? Is it extensible? Is it stable? What kind of signals exist in that? And then you go through the third stage of looking at where this data can be used, right? So for existing data set, this is much more easier. For the new data set, you need to have some sort of extended trial period where you deploy the data set, and then you try to keep track of the usage of the data. If you can do this on API level, that would be great. Otherwise, you use on kind of a per use or licensing service based. The fourth stage would be trying to kind of see, do some impact analysis, like how, what would be the importance of this data in your important application or critical application, assign some score based on the criticality of the use. And ultimately, maybe if you can do some sort of an outage analysis, like what will happen if this data is not available, what will be the business impact? And that will lead you to be able to attribute some dollar amount, right, based on how important this data set. So this is much more easier for trading and sales-oriented applications. So some of the kind of a middle back office application will be might require some sort of subjective assessment. And then the sixth step, you need to have some sort of cost accounting, right? So that will involve obviously the cost coming from vendor, licensing implication, how widely this thing being used, plus any internal development cost to bring the data to your enterprise. So that will give you a total cost of ownership. Then you can metricize this based on how this thing being used is, per user or per applications. Now you have the value, you have the cost. Basically, cost divided by value give you a cost of profit. And then you need to, put some variation. I usually put 25, 30, 50% variation on that. And if you get this metric around 1 to 5%, it's good. 10% will be stretch. Anything beyond 10%, I would say, don't bother about it. Mm-hmm. And then, you proceed with the procurement.
Very well, very detailed. Thank you. And that is tangential to my next question, which is for everyone. We'll start with Lorn on this one. Is what is the process you see in evaluating data sets, especially in light of the big sort of structural or systemic shock of last year? Typically, as quants, we want as long a history as possible, train our models onto data sets with the maximum possible sort of history, and have the cleanest possible, delineation of performance over the entire period, which, given last year's events especially, may not necessarily be the case. So what do you do now? Like, how do you evaluate the efficacy of your alpha or risk sort of management process with the new data sets and the added complexity of possible sort of structural breaks in there? How have you seen your consumers, Lorn, sort of deal with that? Has anything changed in terms of how people approach this?
Yeah, for sure. So if you think on the quant side, I think the quant process has shifted slightly. There's a lot more scrutiny around the biases of the data set up front in the process. So there's a lot more discussion around, for example, geographic biases or consumer age biases, income level biases, et cetera, because what they're ultimately trying to do is diversify across the sources they have to try and balance. So I think that always was present. I think though it was typically a little bit more aggregated to the level of just, well, what capture incremental are you adding to my view? Now it's a little bit lower level of visibility of what they're trying to look at. But I think in the overall process, they're able to consume this data fairly quickly and back test it fairly quickly. And they're back testing it very differently than our fundamental clients, right? So they're able to put it live, or not live, but essentially in a trading strategy and see how it performs. Whereas on the fundamental side, that's been a much larger challenge, because what you're doing in the back testing is against reported KPIs. And because last year was so dramatic, and as we talked about earlier, panelization methodologies broke down. Some of the forecasting methods were definitely shown to be problematic. There's a lot more work that's been done there in terms of helping our fundamental clients understand the value of the data and how it can be useful in their context. And I think it goes back to what Sam's talked about. It's back to basics. At the end of the day, one of the reasons why alternative data is so attractive is because it's an empirical measurement of something in the real world. So when I talk about transaction data, it is an actual transaction. So if we get back to basics of thinking about what is this representing and what are the challenges I have in talking about the data. So for example, panelization, I can expose very clearly all the assumptions that went into that panelization and where you're going to have potential pitfalls in your interpretation of the end result. But at the end of the day, what we're really talking about are consumers spending money at particular places, at particular times, in particular ways. And we can talk about behaviors, right? We can talk about the obvious move from online to offline, or excuse me, offline to online, and how that impacts other behaviors such as loyalty, right? You start to have these really basic conversations that are really valuable from a fundamental point of view. So I think the process we've seen in summary is more granularity of discussion around sourcing, biases, et cetera, with quants. And then on the fundamental side, we do a lot more in terms of supporting the use case analysis of how the data is useful, as well as still, obviously, you have to show your back test. You have to show how it relates to the KPI. But that's become, you know, frankly, across the board, every vendor has had their KPI back testings blow up. So now it's much more talking through what can you do and what can you interpret from the data.
Suraj, similar experiences, I guess.
Yeah, I'd have to echo what Lorn says. One of the things that we concentrated on was ensuring we were telling the truth, because you know there's one thing getting extremely high correlations to reported KPI metrics when you've gone from a pre-COVID environment to a COVID environment where you have seen such dramatic shifts in underlying revenues. You know, you can see ridiculously high correlations just because of that one data point moving by a long way. So what we ensured we did was to make sure our panels were robust and made sense as we walked them forward. So we just assumed, we took our panel from the start and we kept walking it forward every single period just to ensure that there was no level of overfitting. And then, you know, we even went as far as showing a pre-COVID correlation and a post-COVID correlation as well. And that got quite a few people comfortable with our data set. But I guess the ultimate thing for us has been product fit. So clearly, you know, we act as a service. What we do is we procure the data from institutions that may not be willing to sell directly to the investment community. We clean and structure the data and then make it available to quants. And, you know, as Lorn mentioned, the quant community are pretty good at just factorizing this data, putting it into their models and coming out with reasonable return on investment numbers. But when it comes to the slightly more fundamental investor base out there, they definitely need a little bit more hand holding, especially when you're looking at such large data sets. And so having the appropriate products is the absolute key.
And Cetin, you also have had quite a few sort of shifts, I presume, in the way that you use this data. I think from my experience as well, in terms of, you know, something as basic as market impact modeling, like estimate what your cost of trading will be with the models that we historically and typically use, looking at things like spreads, volatilities, participation rates, etc. All these things with March and April last year, you sort of throw them out of the window. And then the other problem is in May and June and July, what do you do with that history that is such a significant sort of outlier in your evaluation of models? What have you seen from your side in that respect?
Sorry, is that question towards me? I missed the...
Yes.
All right, so is it about okay, so I think what I will add to what Lorn and Suraj said is, to me, is like the most important thing is having a unified way of handling data, whether it's fundamental data or whether it's you know, price market data or alternative data set. That's the most important thing. So if you try to, most suboptimal approaches I have seen is dealing with the different data sets completely differently, and that kind of complicates things and, you know, makes introduces lots of problems. So how do you ensure to kind of a uniform handling? So my approach is kind of based on 4 pillars, right? The first one is having some sort of a unified metrics framework. So you metricize the data, you know, extract the numerical aspect of it, metricize it, and then you turn that into a time series. Even if it's not a time series data, you can always assign a, you know, 1 point, make it a 1 point time series. So then, you know, the entire data become time series. You can use the whole time series, you know, pipelines and libraries to process it. Obviously, not all data is numerical or time series. You have to, and even with the numerical data, there are kind of a different dimensions and attributes associated with it. So you have to complement this metricized numerical data with an extensible metadata attribute framework, where you can basically add additional color to that data. Now you have the you know, metrics, you have the attributes, you combine them and you create data sets. So data sets are basically will be the building blocks of your data estate. You have to uniquely identify and classify them, put into a kind of a central repository, you know, kind of version control them, and, you know, properly manage and, you know, make it available to the rest of the organization. And now you have the data sets kind of uniformly structured. Then all the processing, whether it's in your model pipeline, visualizations, or reporting, that become a lot more straightforward because all of them deal with the same structurally same sort of data. So in my experience, when you do that, you not only simplify all your technology and processing pipeline, but also make it much more easier for people to understand what is going on. In fact, you make the data driven, right? So that's the how I will approach this.
And Sam, from your vantage point, as a quant in a more sort of fundamentally built house, how do you go about evaluating data sets, proving their sort of that it's worthwhile investing in purchasing and parsing and consuming this data? Can you share a little bit about the process?
Certainly can. I think although we are predominantly discretionary long only, the sort of sophistication in terms of the quantitative aptitude of the fund managers is quite sparse. Sorry, it's quite diverse. So we have a gear fund, which is purely systematic. So we kind of solve for a quant problem first, and that usually can then pervade to a discretionary problem. So if it's a discretionary manager asking, can you help me prove or disprove this following hypothesis using this data set? We'll also think about the quant view. So when we backtest, for example, we'll do the KPI style, hit, miss, up, down, but we'll also do bucket backtesting. We'll also do strategy backtesting. So similar to what Cetin said, we have a pipeline. So we get the data, we load it in raw, at which point a data scientist will go in and do EDA to make sure that what they're sending is correct. Or is aligned with what we're expecting. Some vendors like putting -999 rather than nulls and those sort of things. We go in and sort of really get in the detail, at which point the data engineer will be building the pipeline to a golden source. So in some cases that could be building a full data mart or data warehouse so that we have, by temporal, we can see what was wrong in the past. One of the questions that's come in from the crew watching is actually, do you have issues with look forward bias? And we do see some vendors who always send us the 2020 view. And what we want to do is for them to send us everything, including what they got wrong in the past, even if it's human error, even if they fat fingered 10 instead of 1, we want to know what was wrong so that when we backtest, we also get it wrong. So that's part of the journey, at which point we can say we've got a fairly cleansed data set. At that point, again, the data scientists come in, they feature engineer and they model build, but it's a full factory style approach with data engineers, data analysts, and data scientists all slotting in at various points in that delivery. But we solve for the quant problem first, because you almost always indirectly solve the discretionary manager challenge there. I think this is also about the not getting stuck in the detail. Wood for the trees problem, which is traditionally quite a quant problem, is you provide a beautiful answer to a question no one asked. So you want to make sure that what you do generalizes and can be used by multiple desks. So I'm lucky that at Jupiter I have that diversity of fund manager who all have their own active way of solving problems, because it means that I can solve the quant first and pervade the discretionary. I think some of my peers who work in just discretionary shops can get a little bit frustrated, particularly when you're trying to correlate 20 data points and they want it to be 100% right. Deary me, that's probably not going to be the case. So I'm quite fortunate, really.
That's great. Which brings us to the topic of fundamental versus quant and systematic approaches to alternative data, which I think we've touched upon in quite a few of the points so far. But maybe for Lorn and Suraj, what would you say is your biggest use case? Is it more the fundamental shops? Is it more the quantitative? Is there a sort of a significant shift one way or another?
I guess from our standpoint here at Fable, the early adopters of our data have been quantitative and systematic, simply because they've got the big data capability and the capacity, and we do as much as we can to ensure the data is workable within their framework. But that's not to say that they are the only users of this data, because some of the world's largest discretionary funds, who have very, very long holding horizons, are also evaluating or buying this data from us, because they like to look at this data in a very, very different way than, say, a systematic fund may want to look at it. So, for instance, they'll take a much longer time horizon just to see how consumer behavior is actually changing, to start challenging their fundamental thesis. But then the other thing they're starting to do is, if you look through any annual report, the level of granularity that you'll ever see in terms of breakdown is only limited to what management, quite frankly, want to present you and what they need to present you and what is within the law that they have to present you. When you start digging into a consumer transaction data set, you can start asking some real key questions as to say, well, why have you expanded into this area, or why is this shop format coming on board when it's clearly not particularly profitable for you? And then you can start taking these questions back to actual management. So I think there's definitely use case there. On the flip side of that, you actually have a fair few corporates starting to buy this data as well, which is fantastic because it's kind of, closing the circle on this ecosystem. Clearly, the corporates are questioning the data in slightly different ways, in that they're trying to figure out where the best place to put their new store is. But as they're getting more and more familiar with this data, they are also trying to preempt some of the more fundamental questions that investors may start asking them. And finally, the most novel use case we've actually seen from our data set, which I was quite frankly shocked by, but it's great, is algorithmic or systematic investing, or systematic finding of investments by VC funds, very, very early stage VC funds. So they're not really bothered about having data on 100,000 consumers, because you're looking at businesses with potentially 10 or 20 consumers, but they like to see that this business has gone from 10 to 20 and then potentially approach the management team. So it's a nice way to start sifting out where potential investments can be made.
Very interesting. Lorn?
Very similar. I think in terms of the trend that we're seeing, I think we're actually starting to probably see more SAMs of the world, which I think is great. I think, it's easy to start on the quant side because, as we've mentioned, they're ready to ingest the data, they're ready to back test it, they understand all the nuances. On the fundamental side, we see a lot of interest, but what's interesting is the blending together, right? As Sam said, starting on the systematic side or the quant side, you can still serve a lot of the discretionary use cases. And we've been seeing a lot more of that happening in the world. And that ultimately allows us to serve them a little bit differently than just a pure fundamental fund, where they're looking at something like a dashboard, let's say, where we can start serving them along with a dashboard, also a feed of data that they can start utilizing in more sophisticated modeling or forecasting, or however they want to deal with the data. And that's been fairly significant shift over the past year or so.
Cetin, I'm not sure if you have any particular views on that, because you're a combination of corporate and trading and
Yeah, I think I kind of mentioned about the importance of the uniform processing. I mean, there's been questions about look ahead bias and stuff like that. I mean, most of the data we do, we have a lot of our own custom data sets. Obviously, we ensure that like dividing the data sets into kind of the different windows and back testing it, and then using the calibrated models on the data which hasn't been seen by the model to do kind of a further testing. So that kind of ensures the prevention of the look ahead bias type of anomalies. But I mean, ultimately, whatever data set you get, you need to have some sort of a kind of a trial period or some sort of a staging area where you run those, whatever model you build fit those data sets against the data which hasn't been seen by the model at all. So usually, I mean, in the asset management space, they do this for a while and then see the live testing and kind of see the performance of the alphas before they can even consider about putting money to it. I think that's the ultimately best way to deal with it. But also you build some sort of a history and about, I mean, I mentioned about the reliability of the vendors. So you look at the how reliable in terms of like the sort of data they provide, how often you see outliers or errors in the data. You have to keep track of all of those, very important. And that kind of gives you some sort of a vendor credibility as well. So, if they've been, doing a lot of errors and their processes are not really great, then there might be some suspicion. Yeah, maybe they're kind of looking ahead as well, just to kind of spice up their, signals. And finally, I wouldn't really that much rely on the actual signal in the data. I mean, I will want to look at the raw data and then, generate all the kind of the additional, derived metrics out of that, instead of relying on a vendor just to tell me, oh yeah, this is like, okay, you can buy now, because that's basically a lot more prone to do this kind of look ahead biases.
So you always need the qualitative assessment on top of the quantitative process.
Yeah.
So let me ask, we have only a few minutes left, so please, for the audience, if you have any questions, put them in the chat window. We'll leave a couple of minutes in the end for any more questions. I think we've answered a few during our talk now, but I would like to ask a more existential question at this stage, which is related to data and alpha generation. Right? So we have immense advances in technology, processing power, modeling tools that are readily available to a scale never before seen. Let's assume that there are data sets out there that are unique. They provide sort of information that can be harvested and harnessed to extract alpha. Is it worth the hassle? In the sense that the more readily available the data sets are, the easier they are to parse, manipulate, process. Can they significantly add value to a real world investments in scale? Or is it an arms race to the bottom?
I don't mind taking that. I think that it's a really good question. I think that the honest answer is it's absolutely worth it, but you want to make sure you start at the basics and you move up. Even there's lots of talk around alpha decay and how certain data sets everyone's known about. Some one well-known US-based credit card transaction data set. Everyone, whenever the name comes up, it's neither of these guys, so I feel safe saying it. They say, oh, there's no point having it anymore. Everyone knows how to use it. But what people miss out on is that quite a lot of these things that were originally alpha become beta. And you can see certain stocks move as much when that data is released as when the stock prints its results. So in some cases, you need to be mindful of the fact that, yes, alpha may decay, but it may then become a component that you just need to know about. That being said, I think it is a bit of an arms race. People go and build teams of 50 people. They spend 5 million on cloud compute and they go and smash 20 data sets to pieces. And I don't think that's the right way to do things. I also don't think it's particularly ethical to be just burning up, GPU and TPU time, just trying to find stuff. Yes, I think people will win through a combination of quant and fundamental. I think a quantamental vision is really where things are going to work. I think empowering fund managers to have orthogonal access to different data sets is the right way forward. And the nomenclature we have internally is creating data citizens. It's about enabling people to make better data-driven decisions. It's not just having a robot that spits out answers that you trust more than anything. It's about having all these orthogonal sources of information. That being said, people who spend more time buying the data, use the right tools, invest in their teams. We use talent, tech, and data as the sort of wording that I use internally. Will win the race ultimately, because active management is going from being a 10K fun run to running at the Olympics. It's becoming more elite and more challenging and more competitive. And if you don't want to contribute to this, then just go by passive. Otherwise, the people who have the data and the people to access the data and the tools to manipulate and properly interrogate are going to be the people who win ultimately.
Yeah, I mean, I love the term the alpha decay. Remind me the kind of the radioactivity lessons in the physics class, but it's kind of true. And I will say that to that arms race point, yes, there are some hedge funds, looking at the kind of the latest data sets, trying to generate the alphas and kind of capitalize on it. But there's another aspect to it. Like you want to kind of, when you develop strategies, you want to be able to confirm your signal. So if you have multiple different sources of signals, even if you that could kind of confirm some of the kind of some of the other signals you might have. That's very important. And the second aspect is the kind of a smoothing, right? So sometimes you get similar signals, and what you happen to do is that you kind of average them before you make the actual trading decision. So the more different data sets you deal with, different signals you get, is actually better. So even if you're not trying to be the chasing the latest data set, you should still need to be able to kind of get those kind of different ways of different signals coming from those data sets.
Yeah, and I guess, just following on from this conversation, in my view, and obviously I'm going to say this because I'm a data vendor, but I actually genuinely believe it. I don't think the alpha ever dies if you have the ability to, drill into granular data. You can always ask different questions of a data set. And look, let's be honest, there are very few perfect data sets out there. So kind of echoing what Cetin was saying, increasingly funds probably want to start combining data sets together to start producing the most optimal signal. And that will be a slightly different level of alpha than a single data set is providing.
Yeah, I think that's on the money. And I think at the end of the day, part of the combination of data sets is all about offering that contextualization, right? At the end of the day, if you're trying to model something in the real world, the more you can bring either different data sets or knowledge in the sense of a human taking that data and making some level of judgment around it, that is the process. That process can't change. It won't change. You can do quantitative systematic investing, and that's different. But I think if you think about just the long term, there will always be a marriage of a tool and a human.
Thank you. I particularly like Sam's point of view in the sense that maybe initially when this whole sort of alternative data and big processing power was deployed to search for this extra alpha, maybe now we're entering an era where it's actually a necessary condition to have to run an investment process. It may not necessarily produce maybe the alpha that we would like, but you cannot do without it in that respect. And then Lorn and Suraj, have you seen changes in the way, I don't know to what extent your clients actually share their use cases? Have you seen that evolution? Have you seen people using your data in different ways now that they would have a few years ago?
I think it's been a proliferation.
Even kind of regulatory bodies or the Bank of England using your data.
Yeah, I think it's been more a proliferation of use cases by people that previously weren't using it, right? And I think that's right. Like for example, macro funds have always been forecasting, retail sales, GDP, et cetera, using different types of data sources. Now it's just becoming more pervasive across the board. And I think that's ultimately what we've seen. And at the same time, you also see just new entrants in the field of bringing this type of data to new challenging problems. I think the one that Suraj mentioned is a great example, right? VC investing, bringing a systematic approach to that is a great idea in terms of marrying a known process with a known technique, but in a novel way. I think that's more what we've seen. But to be honest, I think to your question, Michael, how you phrased it, the really, really interesting ones, they probably don't share with us. So that I don't tell it on a webinar.
Yeah, I would tend to agree. A lot of clients are quite secretive as to how they're using the data sets. And sadly, I cannot answer, have I seen a change over the last couple of years, because we only launched our data set exactly a year ago today.
That's typical security by obscurity. Yeah, the list of data sets might actually have some signal value.
Great, and I see we're right on time. Thank you very much all for your participation, and thank you to our audience for sitting through this panel with us. Have a great day, everyone.
Thank you.
Thank you very much.
Okay.
Thank you.